You're in the Business Insurance Zone with me, Steve Savant, national financial columnist and money color commentator. This week on The Biz, our premium financing series. And on today's show, our introduction into premium finance with my very special guest, Bruce Haydu, certified financial planner, right here on the Business Insurance Zone.
When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Well, welcome everyone to the Business Insurance Zone. I'm your host, Steve Savant, and we're broadcasting live to a nationwide audience of financial advisors right here in Fountain Hills, Arizona, home of America's largest fountain. And today and all this week, we're going to be doing our complete introduction into premium financing. A lot's been happening over the last 5 years since 2008 debacle with the banks, and now we're coming back to talk about it because it is a major play. And to help us with all that is premium financing today, Bruce Haydu. Hey, Bruce.
It's good to be here, Steve.
Well, welcome. And Bruce, you're a certified financial planner, but what I really try to understand with you is you really have an interesting take on premium financing, and you're doing it. Some people talk about it, but you're actually doing it. I want us to kind of introduce people to why wealthy Americans don't use their own money.
Well, that's why they're wealthy. They've leveraged their wealth and use other people's money. They'll take an asset to the bank, they'll trade it in for another asset, they'll use that asset to make a profit, sell the asset, and then pay the bank back and use that profit. So it's been done for generations, and that's how the wealthy roll. That's how they multiply their wealth, through leverage.
Well, I see a lot of affluent clients, they use their home mortgage, maybe get an equity line of credit. People have margin accounts for securities. So this isn't really outside the normal thinking of the wealthy American. This is how they do this.
Right.
Now, I don't know about you, but insurance is kind of a necessary evil sometimes. You know, we have to buy it, and people will say, well, who wants to spend money on insurance? Well, I would want to spend money on life insurance, disability, my car insurance, all the insurances that we use for protection.
Sure.
But if I was able to come to a client of affluence and present to him that there's a better way to buy this, and it's economic, it has leverage, and has the impact, huge economy of scale here. Let's talk about, kind of introduce ourselves into why our wealthy Americans now, and the banks are playing, because this is the big issue. We always knew wealthy Americans wanted to do this. We knew we had very, very good life insurance. I mean, the discount rate on life insurance has changed over my last 20 years. It has changed dramatically. A second to die is an example. I just did this a couple days ago. A male and female 65, both preferred $1 million worth of coverage. That guaranteed premium was, back in the day, $26,000. Today, it's $9 grand.
Right.
I mean, things have changed. So we know the leverage of life insurance is great, the tax advantages are great, but now we're talking about the ultimate leverage, using my client's credit to really leverage this up. So let's talk about a traditional idea of why does a bank want to play with this?
Well, banks want to be fully secured, number one. They're looking for a safe harbor where they can put their money. As you know, CDs are paying 1/4%, 0.5%. So there aren't many fixed areas that banks can play in this world and make a good profit. Our program, which has been around for 13 years, is a coordination of bank lending and the correct insurance product. It's a match. And the banks love it because they're fully secured. Our clients are able to get the large amounts of insurance they need with the high probability of no out-of-pocket cost. And that combination is very powerful. And the banks have agreed to make these loans without debt service being required. In other words, interest will roll up in these loans. So you're securing the coverage you need if you have sufficient net worth, and you're not writing checks. And that's very, very powerful for business succession, for wealth transfer, for family wealth transfer and estate planning, for key man insurance, for a host of uses of life insurance. And we have a particular twist in order to deliver what we feel is the best program.
You said earlier in your opening statement, you said something about the correct life insurance.
Yes.
I think it was like, talk a little bit about what you mean by that, because there's so many carriers out here. We play with 85 different carriers. Are there certain carriers and product lines that are much more geared to premium financing?
Yes, and I don't really want to mention carrier names at this point, but suffice it to say that we used a fixed life insurance product. That is, the cash values are never invested in the stock market. So it's fixed indexed universal life.
So no variable.
No variable. Nothing's invested in the stock market. All of the money, meaning the premiums that are borrowed from the bank, goes into a fixed account, which is primarily a high quality bond portfolio, laddered over 25 years, some high yields from the past, some low yields from today, paying in the range of 5%. So that's the structure of the product that we use. But not all products are the same, not all carriers are rated the same, not all expense ratios are the same, so we have to be very careful.
Do the banks really care about the rating of the carrier?
Absolutely.
Now, is it just AM Best, or is it carriers across the board? Like S&P, Fitch, Moody's?
Yes, they care about the quality of the carrier's reserves, because that is the primary source of the bank collateral. If they take $100 and lend it in the form of a premium into one of these policies, there's immediate cash value in the policy of about $95. So the only difference is $5. So you're creating a debt of 100, but you're creating an asset of 95 at the same time. So the only gap there is about a $5 gap that is at risk to the client.
So really, the banks, if they can collateralize and cover that 5% or their spread, whatever it is, that's all they're really looking for, a quality asset, I'm assuming somewhat liquid, and that they could get to in the case of the worst scenario.
Well, in our program, clients are required to post collateral. And the collateral can remain working for them in their stock brokerage accounts. It can be a mutual funds, stocks, bonds, money market instruments, CDs. That can remain in their name as long as the appropriate amount of collateral is assigned back to the lender. And of course, the majority of the collateral is already in the cash value, which the bank has lent into the policy in the first place. So once the bank is fully secured, then they can offer high quality, low cost, long-term loans.
Well, when we come back, we're going to continue our discussions on premium financing with Bruce, and we're going to talk more about how we can play and put this in our practice right after this break.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Did you know the average 401k runs out of money just 7 to 8 years into retirement? Time Magazine, the Wall Street Journal, and many other publications have warned of the difficulty of saving with a 401k. But what if there was a way to create tax-free lifetime retirement income with no stock market risk? Good news, there is.
You know, living in fear of the next market dive is not the way I want to live my life.
Why would I go out there and take on risk when I don't need to?
I have a lot less stress knowing I can't lose any more of my retirement savings in the stock market.
Call now to receive your free, no-obligation analysis of what this retirement vehicle could do for you, a comparison to your current retirement plan, and a free video that explains this exciting opportunity. Start planning a retirement you can enjoy instead of worrying about future tax increases and stock market losses. Creating income that will last your entire life is the most important thing you'll ever do. Take control of your future. Call now for your free analysis, comparison, and video.
Well, welcome back to the Business Insurance Zone. I'm Steve Savant with Bruce Haydu. And remember, you can order today's chart toppers at thebiz.tv. And just a heads up, before moving forward with anything you hear on our show today, always consult your tax advisor, and if you're FINRA licensed, your broker-dealer compliance officer. We're talking about premium financing, and I'm surprised because back in 2008, it was a debacle. The whole premium financing market, it seemed like all banking institutions, even the biggest European, were pulling out of our market. Things have changed. I mean, it has really changed. But have you seen, and you brought up this issue about collateralization, so we're talking recourse. But is there much non-recourse business going on outside?
Not with low interest rates.
Not with low interest rates.
Non-recourse means more risk to the bank, so they have to charge more for that risk. Predominantly, our programs deal with recourse.
Well, when we think about what happened to the banks, were there much repairing or reparations we could do with a premium financing case? Because you went through this, you've been in this 13 years, you already went through the worst debacle. How did your cases fare?
Well, that's interesting you asked that question. We have some constraints on our program. In other words, we don't try to put round pegs in square holes. We try to design something that has a very high probability of success. And by success, I mean being able to loan exit within a 20-year, 15 to 20-year period. In other words, paying off the bank and then having free and clear insurance for the rest of your life, either producing income or not, that's your choice. So some of our constraints are to keep the client from age 70 or younger. All right.
That sounds so counterintuitive in the old days of premium financing. We were looking for a shorter timeline, older client, even better, substandard older client.
That's right.
So what happened in this thinking?
Well, you're talking about life settlements, and this is not at all what we're talking about. We are not talking about trying to sell a life insurance policy and reap a cash benefit from that. We are talking about permanent lifetime coverage for specific needs such as business, estate planning, and other important uses of permanent life insurance. This is not life settlements.
So at 70, or actually at the end of the term, 15, 20 years, whatever that is, your modeling is targeting those dates to be completely free from the bank. You've already paid them back. They're completely whole.
Right.
And now you're moving forward with the benefits of the policy for whatever the recipient is, death benefit or income.
That's correct, because over the course of time, we're borrowing money at low cost and we're growing. There's a very high probability of growing that money at a rate higher than the bank loan. And that combination of compounding over time builds up excess cash, allows us to pay the bank off, leaving enough cash to carry the policy to age 100 and 120, therefore. So now the person covered has full benefits of life insurance for life without paying money out of pocket.
What's kind of the entry level for a client? I know you're looking for 70 and under, but what about net worth? What kind of net worth do I start? What's my starting threshold?
10 million without home, and in our experience, which is over 10 years, we have not placed this type of program on someone worth less than 15 million. We have several clients worth hundreds of millions. We have two worth over $1 billion, but predominantly it's in the 20 to 50 million range.
So if I hear this right, I'm looking for people, probably my big, under 50, would you say? Is that too young?
From children's ages to age 70. The sweet spot might be 35 to 65.
Oh, really? That far down?
Yes, sure.
See, I would have never thought that. I think a lot of people coming from, remembering the days of the mid-2000s, that everybody was looking for older clients so that they would die on time, that this wouldn't be a deal. But we're talking about a completely different format and model.
Our model is not dependent on death. No one has to die in order to get any benefit. As a matter of fact, we would prefer to loan exit before death, so that, and the younger you are, the greater your chance of loan exiting sooner, because young people pay lower premiums and have lower costs. So you have more money building in cash, which can eventually pay off the bank.
Well, when I'm looking at the capacity to grow and outperform whatever the bank loan is, have you found in most of your modeling, because you're using indexing,
yes,
right, and are you using any specific, are you using S&P, are you using Russell 2000, or what's the traditional indice that you're using?
The traditional might be the Dow or the S&P. We tend to use a blend of indexes, point to point, or monthly averaging, or a variety of modeling in that regard.
Does the banking institution have a call on that?
They do not. This is done by the carrier, and that's why the carrier choice is very important, because you want a carrier who's experienced in options trading. You want them to have a robust options trading desk. The volume will reduce the cost. The cost will translate to lower policy expense ratios, and that will translate to an earlier loan exit for us.
In the tradition, people that are paying premiums now for all the things you've talked about are paying out of their own pocket.
After tax dollars out of their own pocket.
Dollars,
so if the premium is $250,000, they might have to make $450,000 in order to pay that premium. And then whatever is beyond that to live their lifestyle. So it can be quite expensive, not to mention the gift tax. Someone who needs life insurance for estate planning will not own that policy in their own name, because that death benefit will make their estate tax go even higher. So they'll put the policy in an insurance trust, an irrevocable insurance trust, and then they'll have to gift premiums to the trust. When you gift a premium, those premiums can be taxable up to above 40%. and that adds to the cost.
So there's a huge leverage and really helps the client really make an economic decision and really leverage their estate in probably the most efficient way out there.
And one other thing, there's no lost opportunity cost, because now they're not taking that money and throwing it into a policy, they're saving that money, it can be invested elsewhere.
Well, you can watch all our shows this week, including this one on our red on-demand video button right on our homepage at thebiz.tv. That's the Buzz on the Biz for today. Get in the zone, the Business Insurance Zone.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.